Good morning. My name is Seth, your Metro Detroit real estate expert. And with me today, as always, your mortgage expert, Steve Frost.
Yes, sir.
Couple of points today. One of the points that I'm going to hit on is something that Steve touched on very lightly last week, which was that home sale prices have been raising about a 0.5% per month in the past 6 months, which is signaling to us that we're going back to the pre-pandemic national average of like a 6 to 7% appreciation rate with a home, which is a nice and healthy place where we want to be because things don't get too out of control. But one thing to note from that is that we're not regressing. So that crazy growth that we got in these past couple of years, it happened and it's there to stay. That's why prices are so high right now. But now we're on a lower trajectory to start going in that stable range where we're only 6 to 7% a year. Another point, new listings have increased 8% in the recent months, but we're still 20% below the inventory that we were pre-pandemic levels. So this is why last year Steve and I were talking about these crazy inventory levels and how they were so low. And now that even though we've gone up almost 10%, they're still 20% below what they were in the norm in the like 17, 18. So that's crazy to think, right, Steve?
Yeah, I mean, and it's seasonally, it's normal to have inventory increase this time of year. So it's a there's a lot of that. I do a weekly email and I always do housing crash update in it, kind of as a joke, like a tongue-in-cheek section of that as a comment. Because people keep looking for this housing crash like we
Yeah.
had before. And if you look at listing data compared to like 2008, 9, 10, it's just such a wild comparison compared to then to now,
Yeah,
that
it is.
there is so much demand, and the growth rate of households in the United States we're in an upward trend in that. So the way you look at that is like, what's your first time home buyer? Or when are people buying houses? What's the age of the most common home buyer, first time buyer right now, which is the creation of a household, is somebody that's 33 years old.
Uh-huh.
And so if you look back at birth rates from 33 years ago, there's a continued trajectory up. And if you look at it back from 2008 and 9, and you go back 30 years from there, a lot of those people were coming off of, and I'm not trying to get political or anything like that, but a lot of that time where we were looking at birth records from then was heavily influenced by Roe v. Wade. And so there is the birth rates in of that time, 33 years before the big housing crash, was very low. And so you didn't have nearly as many buyers as you do. So now we're expanding exponentially as a country in developing households,
Hmm.
and we're still at a very, very low, record lows for inventory is
Right.
going to continue to keep that supply tight and going to continue to keep values moving north.
Correct. And to note on that as well is we took there was a big hit on house development for a period of time, right? So we're still lagging behind that. And the only way that you can make new inventory is to build new houses, right, Steve?
Yes. So a lot of people tell you, that again, going back to the housing crash, right? Everybody wants a housing crash. Like, hey, these foreclosures, we need these because then there'll be inventory. Well, what'll happen is yes, that's true. There will be a movement, right? That will be good for mortgage people and it will be good for real estate agents. But from a consumer level, you're displacing a household, which that household is going to need a new household. And so it's not creating inventory. They're just moving from one place to another.
Yep.
That truly the only way to create that inventory is to create new housing. Now, one of the things that we're seeing do a lot more are like elder care facilities, memory care facilities, and some of these. I don't want to call them nursing homes anymore because I don't know if that's the right term for it, but or it's these large multi-unit facilities for elderly people. And so those facilities, people are like, oh, I hate seeing these things go everywhere. It's like, well, that is creating new places for people to go, which is moving out of getting some of these baby boomers out of some of these houses that they just can't pry them out of. So as they start moving into some of those facilities, and we continue to see that sector of multifamily housing go up, that does help
Yeah.
inventory, but that is truly how you create inventory, is to create more doors for people to walk into.
Yeah. I think the term that you're referring to is a co-op.
Kind of a
or
co-op. A
not?
co-op's like an apartment, but it's like heavily governed.
Oh, okay. All right.
So
Then
co-ops are
disregard what I just
yeah,
said
yeah,
then.
they're really common in New York City and stuff where you actually own you own shares. Like a building would be almost like it's almost set up like a corporation, like a lot of co-ops you've got to be approved by the board to move in, like personally.
Oh,
Like
okay.
you don't
But
just get to buy the co-op and move in, like the board has to approve you and all kinds of stuff. So a
oh,
little bit
okay.
different, but it's I don't know. I didn't want to say elderly care. I don't know the right word for it. So, but you know what I mean.
I know what you mean. I know what you mean. The last point that I wanted to hit on before we move into interest rates is that the median U.S. home sales price has yet again hit an all-time record of 387,600, which is just crazy to think that your average house is almost $400,000. Isn't that crazy, Steve?
Hmm. For sure.
But that's it for me. What about with rates this week? I see they creeped up just a hair above
Yeah, I
7%.
mean they're really trading in a channel, right? So they're just under or right around 7%. If most of what I'm doing right now is like the high sixes because there's a hurdle there, right? So you just structure the cost on the loan different ways and you get a loan with the six in front of it, and it just makes it a little bit more palatable for people. So that's really what we're seeing trade. We're really we traded sideways all week. We'll be up a quarter point, we'll be down a quarter point, up a quarter point, down a quarter point by the day. Today we got some manufacturing numbers that came in a little bit strong. So today was a down day. Yesterday was pretty much flat. We're leading into a 3-day weekend, so you don't typically see a lot of activity. Now, Tuesday will probably be a little bit more aggressive because we have economic data coming out next week, and we're coming off of more of like a subdued market for the 3-day weekend. So that's really where rates are trading. One thing I do want to touch on though, going back to what you said was about property appreciation, and this is just kind of like a general financial thought, right? So we've all heard of compound interest. So you invest your money in Apple stock or Amazon or whatever you want to buy. And say you take, let's say you said the national average was 387,000, right? Is
Correct.
that what you said?
Yep,
So if
387.
you think about it, right? So a down payment on $387,500 for, let's just say a 5% down is 20 grand. So if you put $20,000 into a house, you can have the value of that $387,000 home compound, right? Because it gains, so year one, it goes up, let's say 6%. So that's roughly 20 grand, right? If 20,000 is 5%, let's just say it's 21,000, 22,000 is your new value, right? That's the amount it appreciates. So now after 12 months, your home is now worth 404,000. Well, then say it goes up another 7%. Well, now that home is up, that 404,000 is now 27,000 more, right? So now we're up to 431,000. So after 2 years, your $20,000 investment, right? Your cash on cash return has now made you 50,000, 40, $50,000 wealthier, right? By the way of equity in your home. So if you think about buying a home, people say like, it's so expensive and rates are, yes, there's that cost that you have for the mortgage. But with the investment into real estate, you take $20,000 of your own money. If you put $20,000 of your own money and you put it in the stock market, it grew 7%, you'd make $1,400 a year. If you buy a house with it, the bank will hang on and will rent you the money. They will loan you the money and you pay interest on it, but you get to capture the compound growth of that asset by only parting ways with $20,000. So if you put
Beautiful.
400,000 in the stock market and you wanted to get that same return, you'd run into a liquidity issue, right? Like you're taking all your money and you're investing it in the stock market to grow at 7%. That's probably not the best idea, but I can take 20,000 and then I can get a payment that I can manage cash flow on. And my asset that I'm doing that on is growing at a compounded 6% per year
Hmm.
on 400,000 rather than on my 20,000 in the bank. So that's really a big like buy versus rent conversation as people say like, oh, I don't want to pay the payments and this and that. And even people look at it and they're like, yeah, but Steve, you're saying that it's compound interest on a $400,000 asset, but I'm still paying interest to buy the house. Well, if you didn't buy the house, you'd be living in an apartment or renting a home wherever you're at. You have to pay to live somewhere.
Hmm.
So the cost is the same. So you can, if you want to rent, that's fine, rent and don't have that growth. But if you have a way to do the down payment, and you can make a mortgage payment work and you can qualify for a loan, you can now put yourself in a position where long term you can have an asset grow in a compound fashion 6-7% a year for the next 10-15 years. Meanwhile, you're also getting to live there, which
Yep.
you have to live somewhere anyway. So it really, if you really think about a home deep down as that financial tool, that it is one of the only ways that you can still take such a small amount of your own money, but gain compound interest and compound growth on such a large asset, which a lot of people don't look at, but it's a really interesting way, thinking about buying a home. Then you take your $400,000 home, it goes up to 500,000. Well, maybe you take that equity and you put it into a $600,000 home. Well, now you've got a $600,000 home growing at 36,000 a year instead of 21,000 a year. Well, now you're doubling your investments. So now you're doing 36,000 is growing at 6 or 7% per year as you continue to upgrade your home. So it's just something to kind of think about in the back of your mind as a financial tool, because it really is like the final frontier for generating a lot of wealth in a way that you can do with very little money out of your pocket.
Absolutely. Awesome point. And to wrap and put a bow on that tangent, to think about if you're renting out a place, a house, an apartment, the person who owns that place that you're paying rent to is doing what you're doing, but they're making money off of you at the same time, right? So you might as well take that money and put it into somewhere and make money for yourself, right?
Yeah, that's why if you look at like we call it cash on cash return, cash out, out of your pocket compared to what you're getting on the growth and the income side. Rental properties, the cash on cash returns can be like 35-40%. That's why it makes so much sense.
Yeah, absolutely. All right, we'll wrap it up right there, Steve. I will put both of our numbers here in the description if you need any questions about your mortgage or need to refinance. Steve's your guy. If you're looking to buy or sell, I'm your guy. Thank you.